I moderated a panel here at the World Economic Forum with interim co-chair BlackRock CEO Larry Fink, I should say co-chair of the WEF, ECB President Christine Lagarde, Citadel CEO Ken Griffin, and economic historian Adam Tooze. And the session was titled Decade Déjà Vu. We discussed the parallels between the 1920s and the 2020s. And during that conversation, Larry Fink had a warning about how technology is reshaping society and the global economy. Take a look.
I see that in every industry. And we're probably going to see that maybe in every country, that the scale operators right now are winning. And that does not translate into a broadening of the world's economic economy. And in many ways, it may be narrowing. And to me, it's getting back to what Christine was talking about. How quickly can we see the adaptation and the democratization of AI and technology? To me, is going to be the real pivotal point. Can AI be inexpensive enough and ubiquitous enough that it can be spread across small businesses, medium-sized businesses, and they can grow and have the same advantages of the scale operator? But in this period of time, though, the scale operator is winning. I mean, I see that in the asset management industry. The scale operator is having better connection because of the utilization of more technology. And I think that's just at the beginning stages, and it's going to represent some huge social issues.
I also asked Citadel CEO Ken Griffin about how he thinks about the systemic risk of debt that's financing so much of this AI boom.
The area of recklessness is the spending of governments around the world, who are all, with little exception, all spending well beyond their means. That's the recklessness of this moment in history. This is not a parallel to the 1920s in terms of the recklessness of the private capital markets. It's a story of the recklessness of government spending. Within the private sector, there's a huge question as to where AI will take us. And I was carefully taking notes and listening to what Larry has to say, or to what Madame Lagarde has to say, because this is one of the big issues of our moment. Will AI create the productivity acceleration that is honestly hoped for in Washington and in the halls of government around the world as a way to overcome the profligate spending that we're currently engaged in? Like, the world needs a savior, and the hope is that AI is the savior that we need for productivity. And the challenge with this is it may or may not be. We just don't know yet.
ECB President Christine Lagarde and I had a brief conversation about part of what Ken Griffin was just talking about, which was just how much sovereign debt there is out there and whether there's an invisible line that could turn into a red line.
I think the real question is what is done with that financing that the sovereigns are accumulating. Not all debts are the same. Debt that is invested in necessary, productive projects or necessary for security purposes will always find people to finance it. That's my assumption. Debts that are not for productive purposes, that are not going to sustain growth on a sustainable basis, that will be far more difficult. So I'm not going to tell you that there is a red line. I'm not going to tell you that central banks will always be around either. But I think that the nature of the purpose for which debt is subscribed will matter more than the actual volume.
And then the question on everyone's mind today ahead of President Trump's address, tariffs. Here's what Lagarde had to say.
What matters is to sort of go under the skin of those tariffs and see who is bearing the brunt of it. And we might be surprised. You know, I haven't seen many studies, but there is certainly a study by the Kiel Institute in Germany that identifies the U.S. consumer and the U.S. importer as the key carrier of the burden of tariff. If I look at the U.S.-Europe relationship at the moment, from 2% tariffs back a year ago, we are now at 12-point-something tariffs average across the euro area. With the threat that is looming around, we would move up to 15% on average. With heterogeneity, if 96% of that is on the U.S. consumer and the U.S. importer, I don't think that's a very good outcome, particularly in terms of inflation. So I think we need to really go into what are the consequences, what is the spillover impact, what is the inflation outcome as a result, and how is growth affected by that.